This week, Adios, LIBOR, and hello, SOFR.
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
Welcome back to the Industry Leader Update. Some unexpected good news came just before last weekend. The Federal Housing Administration announced last Thursday that the LIBOR index has been officially dropped and being replaced with the single overnight financing rate, or SOFR, for the adjustable rate home equity conversion mortgage. But there are some limitations and details. We'll get to that in just a moment. This change was formalized, as it usually is, in a mortgagee letter 2021-08. Now, what is the SOFR, you may ask? Investopedia states the SOFR is based on transactions in Treasury repurchase market. Adding the SOFR is an influential interest rate that banks use to price U.S. dollar-denominated derivatives and loans. The road to adopting the SOFR index for HECMs was not a smooth one, as many of you know. And despite years of advance notice of a shift away from the LIBOR, the early deadlines left little time for both lenders and secondary market participants to react or even plan. Now, fortunately, those speed bumps appear to be behind us. However, before you pop the champagne, you're going to want to note these 5 points. First, the expected rate for both the annual and monthly adjustable HECMs will remain tethered to the domestic 10-year Treasury swap rate. Why, you may ask? Well, because the SOFR has no equivalent swap rate. A swap rate measures an investor's anticipation where the average interest rate will be over a period of time, let's say 10 years. Second, the SOFR index is only used for calculating the index to which the lender's margin is added for the annual adjustable HECM. Third, lenders may choose to continue to use the 10-year constant maturity Treasury rate in lieu of the SOFR for the annual adjustable rate loans, not the monthly. Fourth, the current note rate must not be below 0%. Negative interest rates in an index shall be deemed to be at zero. Now again, this is not the interest rate floor for the HECM principal limit factors, only the adjusting note rates base index. Fifth, the SOFR can only be used for loans that will be closed on or after May 3rd, 2021. Now let's briefly examine the 30-day average SOFR index's performance from February 4th to March 11th of this year, the 30-year average that is. A consistent downward trend can be seen moving from 0.07% to 0.031% Thursday of last week. However, the annual data is quite revealing. In March 2020, when the coronavirus was finally acknowledged to actually be a global pandemic, the 30-day average secured overnight financing rate at that time was 1.49%, nearly 1.5%. As global markets and banks pushed down their interest rates last spring, the index fell to 0.7% in April of 2020, bounced up slightly in midsummer, and then settled at 0.03% this month. However, since the interest rate that is used to determine the expected rate, and therefore the gross principal limit as we know, or the funds that are available before fees and charges, is remaining tied to the CMT index, there's a question that naturally comes to mind, and that is which index stands to benefit the borrower in the long term, whether they choose an annual or monthly adjustable rate loan. Well, that benefit may be one of the growth of the loan balance or the growth of the HECM line of credit. Slower growth of the loan balance, more money in the principal limit or line of credit. Now, from March of last year to today, there appears to be a slight advantage in using the SOFR for the note rate, at least in the post-pandemic period. Then there's loan pricing, something that may have come to your mind. Originators are going to want to closely monitor their lenders' rate sheets for the pricing of annual adjustable rate loans. Now, in summary, while we're bidding adios to the LIBOR, we do remain married to the CMT index when it's determining the loan proceeds available for all federally insured reverse mortgage loans. And only the annual adjustable HECM it can actually be attached to the SOFR for the note rate. In other words, it'll determine what the renewal interest rate is each year. As with any market change or disruption, time will be the arbiter of the ultimate outcome. Now, what are your thoughts on this shift and why we're staying tied to the CMT? Leave your comments or your questions in the comment section below, and be sure to subscribe to this channel on YouTube. You can do so by clicking the subscription button right above. And don't forget to thank our sponsor, Fairway Independent Mortgage. Click on their banner right above and just tell them how much you appreciate them sponsoring this show, and learn more about doing business the fair way. And each and every Monday, just like today, we release the latest episode of our weekly podcast, HECM World Weekly. It's the nation's only weekly podcast, by the way, for you, the reverse mortgage professional. Thank you for joining us. That concludes this week's show, and we'll see you next week for more reverse mortgage news, commentary, and analysis.